This is Bob Brooks, host of the Prudent Money Radio Show. Today we're talking with IRS expert Dan Pilla and talking about whether it makes sense, this is something that President Trump has thrown out there, to replace the income tax with tariffs. In other words, to set up a system to where all the revenue that comes from tariffs goes to pay the income tax. The more we talk about it, and we talked at length about this today, is the more that you realize he's got an ulterior agenda, and it is to bring more balance into the trade system. Because the bottom line is, tariff revenue would not even come close to covering income tax and the income tax revenue. So we talk about that today, and if you want a great website to go to, just in case you get a chance to go check it out, is taxhelponline.com. If you've got a question for me, if you need some help with anything, go to prudentmoney.com, go to info@prudentmoney.com, and send me an email, and I'll get you taken care of. That's all at the website, prudentmoney.com. Hope you enjoyed the program.
KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, can tariffs replace the income tax system? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, President Trump wants to replace the income tax system with revenue from tariffs. Can it be done? IRS expert Dan Pilla is here to give you his input. Dan, always good to talk to you.
It's always a pleasure, Bob. How are you doing?
I'm good. You know, I never thought we would be discussing this. It just gets a little nuttier every time as the time goes on. But I thought, in all seriousness, I think it's important that we make sure that with all these terms being floated around, that listeners know what they mean, know what's going on, and can kind of make sense of it all. Talk a little bit about what a tariff is.
Yeah, a tariff, very simply, Bob, is an excise tax that's placed on the importation of a foreign product. So when a United States importer, the ABC Import Company, brings in products from foreign countries, whether they're manufactured themselves offshore at their own manufacturing facility or they're manufactured by a complete third party, it makes no difference. When those products are brought into the United States at the port of entry, the product is assessed an excise tax, in other words, a uniform tax on each individual item that we call a tariff. All right. So if you got a 25% tariff on home goods, for example, and you bring in 100 toasters, and each toaster is worth $10, then the importer is going to pay a $2.50 tax on each toaster that he brings into the country. All right. So that's a tariff. It's as simple as that.
Okay, and one thing I want to add to it, take it a step further, is that we buy more from other countries than we sell to other countries, which makes up the trade deficit. Talk a little bit about that.
Well, the trade deficit is just what you said. It's the difference between the products, the value of the products that we import, and the value of the products that we export. And a lot of people are fixed on the trade deficit, and they say, "Oh well, we gotta restrict imports because we don't want trade imbalances." But really, Bob, trade imbalances are not a measure. It's not an accurate measure of the health of the economy of the country that has the deficit. You might export, let's say you export $1 million worth of products to France, and the company in the United States exports $1 million in products to France. Okay, that export goes down as a trade surplus, right? We've exported $1 million, and let's say the American company makes 20% on export, right? They sell this material in France for $1,200,000. So this U.S. company has made $200,000 on their export. Well, now let's say that same company imports another $1 million worth of products from France. All right, so now we got a neutral trade deficit, right? $1 million went out, $1 million came in. Let's in fact make it different. Let's say there's $2 million that this U.S. company imports from France, and they sell that product in the United States, and they make 20% on their investment. Well, now that company has made $400,000 on the imports. They made $200,000 on the exports. This company has made $600,000 in the profit in the United States, even though we show a trade deficit now, right? Because they brought in $2 million and only exported $1 million. That shows a trade deficit. So that deficit is not indicative of the health of the U.S. economy. All right, that company made $600,000. It's a U.S. company, so that means they got U.S. employees. They're paying U.S. taxes. Those employees are spending money in the United States, right? The reason we got a trade deficit, Bob, I mean, the very simple reason is, and there's obviously a lot of factors, but the simple reason we have a trade deficit is because we've got the most powerful consumer economy in the world,
right?
We've got 335 million people in this country.
327 is the last number I saw.
Okay, so we got an extremely strong consumer base, yes. Right? Because yes. we've got an underlying economy that's healthy, and we consume things, and there's nothing wrong with that.
You know, I don't know if it's funny or scary, but the next question that I had after we talked about the deficit is, because I thought about this a lot and kept coming to the conclusion this is just not that big of a deal. But the question was, do you think that a trade deficit is that important of a metric? And I'm with you on that. I don't get it.
Yeah, I just don't think it is, Bob. I really don't. And the other thing is you've got this. Let's just go back to the first leg of the transaction, where the U.S. company exports $1 million worth of goods to some European nation. Okay, so that European nation bought $100 million worth of goods, and they paid, let's say, $120 million for it. Well, okay, that money comes back to the United States, right? I mean that money comes back into, and even in a situation where the U.S. company purchases goods from a foreign nation, right? The U.S. Let's say the U.S. company brings in $100 million worth of wine from France, right? Let's just say that. Well, okay, so they spend those dollars in France. Those dollars don't stay there. Those dollars come back to the United States because these foreign companies then use their U.S. dollars to purchase goods from the United States. It's just what it is a constant back and forth flow. That's what's going on, and so the trade deficit. It's not an accurate measure of the health of the nation's economy. That's the bottom line.
You know, to add to that, you talked about the U.S. dollars. It's important to note that the reserve currency within the system is the U.S. dollar, and it's important that we maintain that.
Right. Yeah, no doubt about that.
Let's talk a little bit about, and you had to get a little bit of a laugh when you heard this, the External Revenue Service. And it makes me, do you ever wonder what it's like to be, I mean, does he have a brand czar? I mean, I get a kick out of it because he's such a sales guy. And did they just
sales guy? It's such a good way to put it. You know, the External Revenue Service, man. Who doesn't like that idea of having foreign countries, foreign producers pay for the operation of the United States government? Doesn't that sound like a great idea? The problem, Bob, is, as you well know, that's just not how tariffs work. It just when the United States government imposes a tariff on the import of a foreign product, there is no circumstance under which the foreign producer or a foreign government pays that tax. It doesn't happen. It's the U.S. consumer that pays the tax.
Right. And one word that I skipped, a term that I did skip over, I want to come back to is reciprocating tariff. We hear that a lot. What's all that? What's that mean?
Well, reciprocal tariffs, and I really think that's what's going on here with the Trump administration right now, and the pressure that they're putting on these various governments around the world by threatening to increase U.S. tariffs on their products coming in. You see, these countries have tariffs. Let's just take Japan, for example. All right. So when we import products to Japan, whether it's United States, whether it's U.S.-made automobiles or more likely agricultural products going to Japan, right, and oil, of course, going to Japan. When they import that, they put a duty. They put a tariff on that product, right? So the U.S. products face a tariff, and the higher the tariff, the less likely it is for the people in that particular country to buy the product, right? So let me illustrate this. Suppose we got a Chinese-made toaster that's sitting on the shelf at Walmart next to the U.S.-made toaster. The Chinese-made toaster is made with slave labor, right? We all know that. At the very least, though, the Chinese labor laws don't come anywhere close to U.S. labor laws. Right. In terms of union and overtime and OSHA protections and retirement benefits and so on and so on and so on, right? So it's not even close. So the U.S. toaster sits on the shelf for $25, and the Chinese toaster sits on the shelf for $10. All right. So what happens is a tariff is imposed on the Chinese product with the goal of increasing the cost of the Chinese product so that it is more competitive so that U.S. products are more competitive, right? So now we've got the U.S. product at $25 and we got the Chinese product at $25. Now theoretically the consumer will say, well, gee, we've got this one product made in America, costs the same thing as this piece of junk made in China. I'm going to buy the American-made product, right? So that's the goal. And that's kind of the ideal of tariffs is to create that level playing field. Well, China's got tariffs on our products going into their country, and as a matter of fact, some products are even precluded from being imported in the first place. And so so they got these big tariffs on us. So now the United States comes along, the Trump administration comes along and says, okay, we're going to impose significant tariffs that match your tariffs. That's a reciprocal tariff. Right, you've got a tariff of 50% on our products. We're going to put a tariff of 50% on your products. What people don't realize, Bob, is that most of these countries that Trump is threatening tariffs on have tariffs on our products that are significantly higher than our tariffs on their products. And so when Trump threatens to raise the tariffs, really what he's doing, and I'm completely convinced that this is what he's doing, is he's forcing these countries to come to the table to negotiate with us to say, okay, we're willing to reduce our tariffs on your products if you hold down your tariffs on our products. So the reciprocal tariffs then have the net effect of being of dropping, right? So both countries end up with smaller tariffs on the imported products of the other country, which only benefits the consumers in those marketplaces.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. If you want more information on Dan, taxhelponline.com, a phenomenal website, a lot of resources, and every book that he's published through many years of doing what he does. Or on that site, you can get a book on just about any problem that you might be having with the IRS, and some of those may have come to light here in this last week or so. But that's once again taxhelponline.com. So, we talked about last month the national sales tax being a revenue to replace the current system. And if you think about it, are tariffs in a way similar to that because it's really about the selling of goods and services, right?
Well, yeah, very much so, Bob. A tariff is a consumption tax. There's no doubt about it. A retail sales tax is a consumption tax. So in other words, the base upon which the tax is focused is consumption, whereas with the income tax, the base is earnings, right? And so a tariff most certainly is a consumption tax, no doubt about it.
Okay, you said this a second ago, and this to me is a very I might be wrong on this, but it seems to me to be a big part of this whole thing, and that is asking foreign countries to pick up the tab for the American way of life just doesn't seem like a good idea. I mean, because it does kind of come across that way, right?
Well, he's selling it. That Trump is selling it that way. But the fact of the matter is that's not what happens. Economically, the tax is paid by the U.S. consumer at the point of purchase, at the end, by the end user. So when there's a we gave the example of the toaster. When the Chinese toaster is sitting on the shelf at Walmart and the consumer buys it for $20, that cost includes the tariff that the importer had to pay on the product the minute it hit a U.S. port. And the idea of having tariffs replace the revenue, Bob, just mathematically is impossible. Right now the federal government will collect in 2025 through all taxes that are assessed. Let's just call it roughly $5 trillion, right? It'd be a little bit north of that, but let's just say it's $5 trillion. Well, about 70% of that money comes from the personal income tax, the payroll taxes, right? That's Social Security, Medicare, Medicaid taxes that are assessed on payrolls, and then money from the corporate income tax. It's not nearly as much as the personal, but that's the three primary sources of revenue. As I said, about 70% of federal revenue coming from those sources. Well, 2% of revenue, Bob, is coming from tariffs. So, I mean, even if you raise the tariffs by 1,000%. You're not going to replace the money that's collected from the personal and corporate income tax, plus the fact, and here's the other thing about tariffs that we have to understand. The idea of high tariffs is to discourage foreign products from supplanting U.S.-made products in the marketplace. The idea of high foreign tariffs is to create a disincentive for consumers to buy foreign products. So if you increase by 1,000% the tariffs on foreign products, who's going to buy foreign products, Bob? Nobody. So you just won't sell anywhere near as many products with that kind of a tax. You just won't do it, right? So there's no way they can replace the revenue using tariffs. It's just simply impossible. And Trump points out, and he's right about this. He points out that at the turn of the 20th century, in the year 1900, the United States funded its federal spending, to the tune of about 80 or 90% of federal revenue was raised by tariffs in those days, and that's true. He's right about that, and he raises the question: well, if we did it then, why can't we do it now? Well, the answer is because between 1895 and 1900, that 20-year period of time, the federal government only spent about $500 million a year, not $500 billion. Bob, $500 million a year. So the spending is just, and now we collect $5 trillion in revenue, but we're going to spend $6.5 trillion in revenue. You can't replace that revenue with a tariff. You just can't do it.
When you go through it, talk through the process, it's just obvious it won't work. Why? What is it about that they don't see? Or they? Well, I think they're smart people.
They do see it,
yeah.
Bob.
So why?
I believe. Go ahead. I'm sorry I stepped on you. Go ahead.
No, you're fine. I was just saying. Then what's the ulterior and alternative agenda then?
Well, I think the alternative agenda is to get 90 countries to agree that their tariffs on U.S. products are way too high, and to get those countries to come to a negotiating table that they might not otherwise be inclined to come to say, okay, yeah, we'll reduce our tariffs by 50% or 60% or whatever the number is. We'll cut them in half, whatever the number is, in exchange for you not taxing the snot out of our products. I really think it's that simple, Bob. I think the president's goal, and it's probably difficult to communicate this, because if he came out in public and said, look, American citizens, don't panic about these tariffs. All I'm doing is forcing these other countries to the table so we can renegotiate their tariffs on our products. Well, if the countries knew that, Bob, if the leaders of the, Japan and the European Union, for example, knew that that's exactly what was going on, Well, they just wait them out, wouldn't they? They just say, okay, we'll just sit here at the table, and we'll sit here in our own country, and we'll not engage in negotiations. But if they believe that Trump will increase our tariffs on their products so significantly based on what he's talking about, I think that forces them to the table, and I think it gets us to a point where the ultimate goal is 0-0. No tariffs on our products going to them, no tariffs on their products coming to us. That's the best case scenario for consumers in America, 0-0.
So what do you think about the situation with China? How do you think that all works itself out?
Well, China's a different story because they just don't have the same restrictions in their production and labor markets that we have in ours. However, and this is a reality, China needs our market, Bob.
Yeah,
we've got the strongest consumer market on the planet, and it's not even close. And they know it, and they can't sell their products around the world like they can sell them in America. So they're going to try to play hardball, and they believe that I'm sure they believe that they've got some bargaining chips, and not the least of which is the amount of U.S. debt they hold. Right, that's a significant factor, no doubt about that. But they need our markets, man. It's as simple as that. They need them.
So, and you write a monthly newsletter called Pilla Talks Taxes, in which you can get more information at the website. And one of the articles, it was a real good article, was Negotiation Strategies for IRS Resolutions. So to kind of wrap up the program, I thought let's talk a little bit about some of these that people may not know of or may or need a little bit better understanding how they work. Offer and compromise. You hear a lot of that on the radio ads. Talking about some pretty big reductions in tax owed. Talk a little bit about that.
Yeah, the offer and compromise, Bob, is the IRS's flagship settlement program, and it's a program that allows a taxpayer, allows a citizen or business for that matter, that owes a significant amount of tax liability that they cannot pay to go into the IRS and negotiate a settlement for less than they owe. All right, so take an individual that's got a $100,000 tax liability, they've got very little capacity to pay. You go into the IRS and say, look, guys, I can't pay the $100,000. There's no way that I'm going to be able to pay this. Either in cash with available assets or over time, based on disposable income, and so let's negotiate a settlement based on your financial situation, income, expenses, assets, and liabilities. The IRS may settle for $5,000 or $10,000. Maybe it's $10,000 or $20,000. Maybe it's $2,000. Maybe it's even less than that. It all depends on your specific financial situation. But the Offer and Compromise program is a very real program, and as a matter of fact, there's 4 different variations of it, Bob. So depending on what your situation is, and maybe you don't owe the tax, or maybe payment of the tax would cause a hardship, even though you do have some money to be able to pay it. All of these things come into play in negotiating an offer and compromise for less than you owe. And it is a program that I've been using for all the years I've been in business, and this is north of 45 years. I wrote the book on using the IRS's offer and compromise program to negotiate settlements. So it's a very real thing with very, very significant potential for settlement if you qualify. And of course that's the key word, is if you qualify.
Talk a little bit about installment agreements. I'm sure people have heard about the payment plan, but talk about how they work.
Yeah, payment plans are very, very helpful as well, and this is for folks that do have the capacity to pay, that owe a relatively small amount of money. Let's say you owe $15,000 to the IRS instead of $150,000, and you've got the ability to make a payment of $400, $500, $600 a month, so you can keep this thing under control relatively easily in the grand scheme of things. In a situation like that, if you owe the IRS less than $50,000 and you can pay within 72 months, the IRS is very generous. Is not the right word, but put it this way. They are very amenable to negotiating an installment agreement under that situation, and that puts the taxpayer in a very comfortable position, Bob. Because once an installment agreement is negotiated with the IRS and it is recorded on the books, right? Everybody signs the papers and it's signed, sealed, and delivered, right? The IRS cannot enforce collection while that installment agreement it's pending. So you eliminate, as the taxpayer, you eliminate the risk of levies and seizures and bank account attachments and so on, as long as you comply with the terms of the agreement. So it's a very, very important tool in getting tax debt resolution.
You know, I've talked to many people through the years and talked about maybe some debt problems that they're having, and they don't want to talk about the IRS debt that they owe, but they go through everything else, and then they mention it. And what people don't realize is if you've got that kind of debt, that's the debt you got to attack first, without question.
Oh, yeah, no doubt about it. Because, listen, the penalties and interest on a delinquent liability are killers, all right? The IRS charges penalties for failure to pay, which is 1% a month, capped at 25%. If you filed your return late, there's a 25%, up to 25% failure to file penalty. Then they charge the interest on the entire liability, the tax, the penalties, the previously assessed interest. All right, it's compounded daily, Bob, on the entire unpaid balance. And to make it worse, it's subject to being adjusted. The interest is twice a year, depending on what the adjusted federal rate is. So as interest rates increase over time, the IRS's rate goes up with it. So it really can be disastrous. I've heard people tell me 1,000 times, I can pay the taxes, it's the penalties and interest that are killing me. So you really got to get on top of it as quickly as you can.
Once again, Dan's website's taxhelponline.com, a great resource. Go check it out. Dan, always great to have you on. Talk to you next month.
All right, I'll look forward to it, Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, go to the website and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.